Welcome to This Explainer, where we're pulling back the curtain on the secret files of trucking insurance. We're going to show you exactly how to take control of your rates. Look, if you've ever wondered why insurance pricing seems so completely unpredictable, you are definitely in the right place. Today, we're decoding the exact metrics, the red flags, and those hidden calculations that happen behind closed doors.
Okay, let's jump right in. Picture two truckers for a second. They apply for insurance on the exact same day, and they're driving the exact same type of trucks. From the outside looking in, their businesses seem completely identical. But this brings us to a massive industry mystery. Why does one trucker get approved instantly with absolutely fantastic rates, while the other guy gets flat out rejected, slapped with strict conditions, or hit with insanely high premiums? What's the unseen force actually making these calls? Well, as it turns out, insurance companies aren't just insuring trucks, right? They're insuring risk.
And the answer to that mystery lies with the underwriter. You can think of an underwriter as a highly specialized risk investigator. Their entire job is to figure out if your business is actually worth insuring. And here's the hard truth. They care 0% about your personality, how hard you work, or your big dreams for your company. They care 100% about cold, hard statistics. To them, the whole shebang boils down to probability, exposure, and potential financial losses.
So let's move right into Section 1, the big driver risk factors. Right off the bat, the very first thing underwriters check is your motor vehicle record, or your MVR. They are aggressively hunting for speeding tickets, accidents, DUIs, reckless driving, and any past suspensions. Why? Because your MVR tells them exactly how risky you are behind the wheel. To an underwriter, a speeding ticket isn't just some annoying little fine. It directly signals a future lawsuit risk, simply because speeding means a higher crash severity and way more injury exposure. The crucial takeaway here is that just one single violation, like a recent reckless driving citation, can literally cause your premium to double overnight. Or worse, it gets your application tossed right in the trash. On the flip side, underwriters absolutely love seasoned pros. Drivers with a completely clean history and years of CDL experience under their belt are the ones securing the best pricing.
But wait, what if you're a super experienced driver who just decided to launch your own business? Well, brace yourself because you might see a shocking yearly quote of $32,000. Even if your CDL is spotless, underwriters look at brand new MC authorities as a massive statistical risk. The data shows that new authorities just tend to have more accidents, weaker safety systems, and, crucially, no proven operating history. Without that track record, your first-year costs can be absolutely brutal.
They also totally obsessed over your CSA scores. These scores are basically the report card of your inspection history and safety performance. Repeated compliance issues. We're talking brake violations, hours of service messes, tire defects, or bad load scarement. They all just scream unsafe operations to the insurance guys. Bad CSA scores make them incredibly nervous because to an underwriter, past claims are the best predictor of future claims. Moving on to Section 2, cargo, miles, and location. Believe it or not, the actual freight you haul can scare insurers away. Even if everything else is exactly the same, a carrier moving high-risk theft-prone items, think smartphones, electronics, pharmaceuticals, or hazmat, is going to pay massively more than a guy hauling low-risk paper products or basic dry goods. High-risk cargo just creates extreme theft exposure and opens the door for some incredibly expensive claims. Your operating radius is a huge deal too. Basically, the farther you travel, the higher your exposure. Long-haul trucking inherently means more miles driven, and statistically, that translates directly to more chances for claims. You're dealing with more fatigue, wild weather changes, and a much higher risk for severe highway accidents. In location matters way more than most folks realize. Underwriters crunch the numbers on traffic density, theft rates, and local accident stats. So, if you're operating heavily in states like California, New York, Florida, or New Jersey, that triggers much higher premiums and way stricter underwriting. The reason is pretty simple. Claims in these specific states are just insanely expensive because of their high lawsuit environments. Which perfectly tees up Section 3, the nuclear lawsuit threat. $10 million or more. That staggering number is the baseline definition of a nuclear verdict. Modern trucking lawsuits are just exploding in cost right now, and underwriters are painfully aware of it. They are literally pricing every single policy with this massive lawsuit exposure in the back of their minds.
Because trucking claims run so high, just one bad accident can lead to fatalities, lost cargo, and a nuclear verdict hitting tens of millions of dollars. This whole trend is being driven by something the industry calls social inflation. Basically, it means juries are handing out much larger, highly emotional awards, and the lawsuits themselves are becoming incredibly aggressive. Because of this social inflation, insurance companies are being forced to tighten their belts, becoming significantly stricter about who they cover and what they charge. Let's dig into Section 4, Red Flags and Fatal Flaws. Now, it's not always just about your driving record. Sure, having multiple accidents and terrible CSA scores is bad news, but poor hiring practices, like skipping background checks, create a huge liability. If you hire a driver with past violations and they wreck, the underwriter sees severe negligent hiring exposure. Also, and this surprises a lot of people, they check your financial stability. Why? Because underwriters know that struggling companies will often neglect truck maintenance or cut safety corners just to save a few bucks. Combine those things, and you're pushed straight into the high-risk insurance market. And whatever you do, don't try to cut corners by committing insurance fraud because it is instantly game over. Misrepresentation completely destroys trust. If you fake your garaging location, like saying you only operate locally, but then they investigate and find your trucks all over the country, or if you hide drivers or haul undeclared cargo, they will spot those red flags. They'll immediately cancel your policy or reject your app, and you'll be left scrambling to find anybody willing to cover you. But hey, it's not all doom and gloom. Let's hit Section 5, How to Win Better Rates. You absolutely can take control and actively lower your premiums. It's all about building a rock-solid safety culture and actually being able to prove it. The smart carriers out there follow these exact steps. They train their drivers constantly, they maintain their equipment aggressively because underwriters know bad maintenance equals future crashes, they actively monitor their safety scores, and they document absolutely everything. Professional, highly organized operations always get the best treatment. Embracing tech is also a real game changer. Underwriters literally love dashcams, telematics, and GPS monitoring. Equipping your fleet with these tools dramatically lowers your perceived risk. It cuts down on fraud, encourages better driving habits, and most importantly, it gives you the hard video evidence you need to defend yourself against those nuclear lawsuits we talked about. So I want you to honestly ask yourself this right now. Looking at your own business, are your drivers genuinely safe? Is your maintenance program strong? Are your records totally organized? Basically, if you were the insurance company, would you insure you? If you're hiding stuff, ignoring your scores, or doing a terrible job screening your drivers, the answer is probably no. Ultimately, the safest, most professional operations win the best rates. To an underwriter, your entire life's work basically boils down to one simple, provocative question. How likely is this company to cost us money? If you master your MVRs, manage your cargo intelligently, and build a real safety culture, you can control your premiums. But that leaves us with one final thought. If underwriters know exactly how to measure your risk down to the very last dollar, do you know your own numbers well enough to prove them wrong?